So one of the biggest question marks in the economy right now is the state of credit. Simply stated, credit is the risk you take of not getting paid back, whether by default or through inflation. And this year, as interest rates rose, credit spreads widened, meaning the risk of not getting paid back appeared to increase. As you can see here, the returns of interest rate, equity, and credit factors have directionally moved together this year, despite having little daily correlation. Credit appears to be a little lagged and muted versus equity, but not really diversifying. And since the June 16th bottom, the market has questioned the fortitude of the Federal Reserve to keep raising rates to tamp down inflation, as signs of a slowing economy have come to the fore. So lenders feel a little better about the credit they have extended. If the slowdown becomes more severe, then I would argue lenders should be just as worried, if not more so, and demand greater coupon payments from borrowers. That's the directional setup here, but let's dig into the best ways to implement in this asset class now. First, some observations to support why credit investing is best left to the pros. Since lenders have asymmetric risk, they earn a little and lose a lot if there is a default. They tend to be a little sharper on pricing than equity holders, who are largely trading off excess profits further into the future and are highly influenced by narratives with theoretically unlimited upside. Credit has been devilish to implement historically due to the lack of liquidity in specific issues and the fact that it's a dealer market, i.e., you have to call around to get quotes. And if you just want access to the market, cap-weighted indices tend to overweight the most indebted companies. Not really the best setup if you have limited upside. For these and many more reasons, opportunistic credit strategies that attempt to make money via credit selection have been investor favorites in the hedge fund world, although they are more capacity constrained than others due to the relatively poor liquidity, as mentioned, and therefore tend to charge higher than average fees. Let's see what the industry offers at this important juncture. So I chose 10 of the largest UCITS credit hedge funds I could find with a positive risk-adjusted return from the Kepler website, link and names in the description box below. All have over $100 million in AUM, and you can readily implement them. Over the last year, with the high-yield ETF down minus 7%, an equally weighted exposure to these active managers saved you money down only about 1%, with a 0.2 positive beta to credit. Residual or returns from credit selection was inconsequential, and Kepler notes that investors have been withdrawing capital from this space, along with others, this year. Not great, right? Well, perhaps this tricky environment is too much for even the pros, but let's dig in a bit and see whether anyone did generate alpha over the past year. Looks like Pictet Sirius, Lumina Blue Cove, BlackRock, and CIFC did generate some alpha. Well done, but let's see what this looks like year to date in the down and then up market we've had. Blue Cove and Pictet come out on top. CIFC looks like a cash plus vehicle, and BlackRock looks highly correlated with the drawdown control versus the high yield ETF. Interestingly, Pictet has seemed to fade during the rally, implying a short bias to their strategy. Only Blue Cove made money on both the down and the up legs in the market, and this has put them on top of the heap this year. Fun facts about Blue Cove: it is the smallest fund out of the 10 at just over $100 million. And it is the only fund that implements its credit selection strategy systematically. That is, with human oversight and design, but trading algorithmically. The breadth advantage this affords them versus just humans trading securities is well covered in prior videos. And it's interesting that pioneers of this approach within credit are outperforming. Perhaps a topic for a deep dive in the future. Well, that's all for me today on Money Managers, a User's Guide. If you found this content helpful, don't forget to like, share, subscribe, and hit the bell for notifications of future episodes. And remember, use your money managers. Don't let them use you. Thanks.